Today, we're diving into how one country, Thailand, is really doubling down on attracting international investment through its tax system. You shared some fascinating source material on their property tax incentives.
Yes, and it's quite a deliberate strategy. The details we're looking at come largely from Ocean Worldwide. Their luxury real estate agency been operating since 2004, primarily focused on Phuket and Koh Samui.
Right. And actually, before we even jump in, let's nail that pronunciation because it's important, especially given Ocean Worldwide's base. It's Phuket, Phuket, not Phuket.
Exactly. Phuket. We should stick to that.
Definitely. So Ocean Worldwide, they're seeing this firsthand in the luxury market.
They are. They've helped thousands, literally thousands of investors and families, according to their director, Sandra O'Neill. Their perspective shows how these tax rules aren't just abstract policies. They directly shape investment returns, especially in high-end markets like Phuket.
So our goal today is basically to break down these key tax advantages and see how they actually, affect an investor's potential profit.
Precisely. From personal tax breaks right up to big corporate incentives.
Okay, let's start small then. For an individual, maybe someone listening owns a condo they rent out. What are the immediate kind of day-to-day tax perks?
Well, the Thai system offers a pretty straightforward starting point. For personal rental income, you get a standard 30% deduction. Just boom, 30% off the top.
No receipts needed.
No receipts needed for that 30%. It simplifies the whole tax filing thing massively.
Yeah.
Then the remaining 70% of the income is taxed at their progressive rates. Starts low at 5%, goes up to 35%.
That 30% standard deduction is quite generous up front. What if the tenant is a Thai company, not just, say, another individual? There was something about withholding tax.
Ah, yes. That's more of a mechanism, really. If your tenant is a Thai company, they have to withhold 5% of the rent they pay you and send it directly to the tax authorities.
So it's like a prepayment.
Exactly.
Well,
Think of it like that. It's not an extra tax on you, the owner. You just claim that 5% back as a credit when you file your own annual tax return. It just ensures some tax gets paid promptly.
okay, simple enough. But then there's this newer reform regarding foreign income. That sounds like a much bigger strategic play.
Oh, it is. This is a really significant change. Basically, if you're a Thai tax resident, any income you earn outside Thailand won't be taxed when you bring it into Thailand, as long as you bring it in within 2 years of earning it.
Within 2 years, okay. And the goal there is clearly,
To get money back into the country, they want people, expats, wealthy Thais maybe, to bring foreign earnings home and ideally invest it locally, boost the economy.
right, it's a very direct incentive. I wonder, though, does the source material mention any pushback or concerned about fairness, offering big breaks specifically to attract potentially very wealthy people?
The sources we reviewed, especially from the real estate angle like Ocean Worldwide, frame it mostly in economic terms. It's about competitiveness. How does Thailand compete with Singapore or Hong Kong for capital? This is one tool. The focus is very much on, encouraging that repatriation and domestic investment.
Understood. Okay, so that's the individual level. Let's scale up. Say you're not just renting one condo, you're looking at a major development or real corporate venture. How do the incentives change?
Right, this is where it gets really interesting for bigger businesses. The main driver here is the Board of Investment, the BOI. They offer a whole suite of promotions.
And these aren't uniform, right? They vary.
Exactly. It depends heavily on the type of business they really like, high tech, for example, and also the location. Investing in certain designated industrial estates or specific regions gets you more perks.
What's the headline perk? If you had to pick one BOI incentive that really grabs attention.
It has to be the corporate income tax exemption, the CIT holiday. For companies that get BOI approval for strategic projects, they can get completely exempt from corporate tax for a set number of years.
And how long are we talking?
It can go up to 13 years in some cases, which is, well, it's a very long time in the business world. Think about reinvesting all your profits pre-tax for over a decade during your key growth phase. Compared to rivals in the region, that 13-year potential is a significant edge.
13 years is huge. That fundamentally changes the calculation for setting up a major operation. Does the BOI offer help beyond just the tax rate, like with setting up, getting equipment in?
Absolutely. They look at the whole picture. So they can grant relief or even full exemption on import duties for necessary machinery or raw materials you need to bring in. That cuts down initial capital costs.
And the big one, ownership. Usually there are restrictions on foreign ownership.
Yes, typically. But for BOI-promoted activities, they can allow 100% foreign ownership. That removes a massive barrier for international companies who want full control without needing a majority Thai partner. It's a very important structural incentive.
Okay, so we've covered direct ownership, individual and corporate. What about passive investment? Like if I wanted to invest in a portfolio of shopping malls or apartment blocks, but not manage them myself, REITs come into play here.
Precisely. Real estate investment trusts, or REITs, they're basically like mutual funds, but for property. They pool investor money to own and operate large income-generating properties.
And Thailand encourages these.
Very much so, through
Sure.
the tax system. The REIT itself, the trust entity, is generally exempt from corporate income tax.
Is there a condition for that exemption?
Yes, there's a key requirement. To get the tax break, the REIT has to distribute at least 90% of its taxable income back out to its investors as dividends.
Ah, so it ensures the profits flow through to the shareholders.
Exactly. It makes them very tax-efficient vehicles for generating steady income. That current rule, by the way, is set to run until the end of 2024, though these things often get extended.
And what if you have an older property fund structure and want to convert it into a REIT? Is that easy to do, tax-wise?
They've thought of that too. There's specific relief available to ease that conversion process breaks on things like V8, stamp duty, and certain business taxes that might otherwise apply during the restructuring. It just makes it smoother to adopt the REIT model.
It really sounds like they're trying to cover all the angles. Let's shift to another angle then, the sort of VIP pass for wealthy foreigners. How does Thailand use tax to attract high net worth individuals specifically?
Yeah, they definitely roll out the red carpet. There are specific visa categories aimed squarely at the wealthy. For what they often call a wealthy global citizen, the criteria are quite high.
Such as?
Generally, you need to show around $1 million in assets, have an annual income of roughly $80,000, and you need to make a significant investment in Thailand, usually about $500,000 in government bonds or property.
And the payoff for meeting those criteria?
Tax benefits, notably including exemptions on that overseas income we talked about earlier, plus easier long-term residency.
Okay, and I imagine the requirements are a bit lower for retirees. We hear about Phuket and Koh Samui being popular retirement spots.
Definitely lower for wealthy pensioners.
Yeah.
You need to be over 50, have a stable pension or income of around $40,000 a year, and the investment requirement drops to about $250,000.
Yeah.
The visa rules are often a bit more relaxed too. It's designed to attract affluent retirees.
Now, for any foreigner investing, whether they're a retiree, a global citizen, or running a BOI company, dealing with tax in two countries is always a headache. Double taxation treaties, how important are they in this picture?
Oh, they're absolutely fundamental.
Right.
Crucial. Imagine you're, say, German, and you own that lovely luxury pool villa in a Thai near Phuket that you rent out.
Okay.
Without a double taxation treaty, or DTT, between Germany and Thailand,
Yeah.
you could, in theory, be liable for income tax on that rental income in both countries,
Right.
which would obviously be a disaster. So the DTT basically prevents that. It sets out rules so that the income is only taxed once, usually allowing you to offset tax paid in Thailand against your German tax bill, or vice versa. It provides certainty, which is vital for any international investor.
Makes complete sense.
Yeah.
Okay, final area. Let's bring it right down to the specific property and its location. How do local factors, like being in Phuket or owning a certain type of home, play into the tax relief?
There are definitely location and property-specific elements. A major one is the land and building tax. For your main home, your primary residence, there's a very high exemption threshold.
Ah,
If the government's assessed value of your house is under 50 million, that's roughly what, 1.4 million US dollars, it's typically exempt from this annual tax. For condos, the primary residence exemption kicks in under 10 million baht.
so that protects most homeowners from significant annual property taxes.
Yes, it keeps homeownership relatively affordable from a tax perspective, even for quite valuable properties if they're your main home.
And beyond the main hubs like Bangkok or Phuket, is the government using tax to steer investment elsewhere?
They are, through special economic zones or SEZs. These are often set up in border areas or regions that are less developed, trying to encourage growth there.
And the incentive is?
Enhanced tax benefits. So if a business sets up in an SEZ, they might qualify for even longer CIT holidays than the standard BOI promotions or other specific perks. It's about balancing development across the country.
That makes sense strategically. But how do they make sure these SEZs with their extra breaks actually deliver jobs and local benefits and don't just become, tax shelters?
That's always the challenge with incentives. Typically, the BOI agreements, especially for the really generous benefits in SEZs, come with strings attached. performance
Like
requirements.
hiring quotas.
Exactly. Things like minimum employment levels, targets for local sourcing, maybe requirements around technology transfer. The idea is that the enhanced tax breaks are earned by delivering tangible economic contributions to that specific zone. The sources suggest the BOI monitors this.
Okay. And even the capital, Bangkok, has its own specific incentives, right? It's not left out.
No, Bangkok gets attention too. Things like reduced stamp duty when you buy property there can make transactions cheaper, keeping the market liquid. And there are specific business tax incentives aimed at encouraging companies to expand within the capital region, so maintaining its powerhouse status.
So when you pull all these threads together, personal deductions, BOI holidays, REIT exemptions, VIP visas, DTTs, local breaks, what's the big picture? What's the overall message Thailand is sending?
The message is crystal clear, I think. Thailand has deliberately, strategically, built a tax system designed to be incredibly attractive to foreign capital and expertise. It's not piecemeal, it's a comprehensive structure. They use tax efficiency at every level, from making it easy for an individual landlord to offering multi-decade tax holidays for major corporations. They smooth the process with things like the BOI handling visas and work permits, and the DTTs remove international friction. It's a concerted effort, and you see the results in the high demand for luxury property in places like Phuket, just as Ocean Worldwide documents.
Okay, so wrapping this up for you, the listener, we heard in the source material about a potential slowdown looming in the real estate sector, possibly leading to a price war. Now, given everything we've just discussed, all these powerful built-in tax incentives, especially attractive in the luxury market that agencies like Ocean Worldwide focus on, here's something to consider. If property prices do soften, how does that interact with these strong tax advantages? Could that combination create a unique, maybe short-term buying opportunity where the tax efficiency becomes an even more significant part of the investment calculation than just betting on price appreciation? That's definitely something to mull over.